Hello, you're watching Deal Flow, the CNBC Africa show that takes a deeper look into deal announcements across Africa and beyond. I'm Erica van der Merwe. Discovery Limited recently bought the remaining portion of its UK joint venture with Prudential Assurance. The 2.8 billion rand deal gives Discovery full ownership of PruHealth, the fourth biggest private healthcare insurer in the UK. Ricky Farber is Discovery's financial director. Lovely having you here, Ricky, to get your perspective on this.
Thank you.
So you now have full ownership over what began 10 years ago as a joint venture. What's been your learnings over this time?
Sure. So we now have 100% of the health and life insurance business in the UK, and we've learned a lot. I mean, we've learned that the UK culture is quite similar to South Africa in many ways, but there are very subtle and important differences. The way people engage in our products, the activity that they do, but probably the single biggest thing is their engagement in online. It's amazing. They're much more active users of the internet than our South African population, buying products, engaging with the service, and so on. We've also learned a lot from the Pru. To be fair, they've been a fantastic partner. The UK regulatory environment is a tough one, and the Pru have been a great help in navigating through that.
How big is the opportunity in the UK market? So you talk about different behaviour, but if you look at the economic opportunity, some commentators have said that it looks as though you might have overpaid for this asset, but clearly there was a compelling reason.
When you look at it cold, you come to that view. You come to a view that says we've overpaid. But the Discovery style is actually to go into a market which looks staid and steady and do things differently, to come out with new products, to engage the consumer, and to use different distribution and really kind of change the market. And to the extent that we've been able to do that and continue to be able to do that, we definitely haven't overpaid. The value will come through. So
you describe yourselves as being disruptive and dominant. So put that into the UK market and tell me what it is that we can expect in the next 5 years or so.
So the whole model of Discovery fundamentally underpinned by vitality, which engages the consumer in looking after their health, and as a result having lower claims, actually for us having lower lapses or leaving us less, living longer, creates value for the consumer, but it creates value for us. And as long as we can do that, then the dynamics are all working incredibly well. And that sort of dynamic, that whole model is new in the UK. We haven't, none of the other insurers have it, and it has quite a resonance. Surprisingly, in some people, but not for us, was the UK, the British people are actually quite engaged, and I guess it's the way the world is going, much more engaged in looking after their health and going to the gym or even just doing basic physical activity. And people resonate with that, and the product resonates, and that's the disruptive nature we've had. The insurance companies in the UK are normally seen as staid and old-fashioned. This is young and vibey.
Yes. This joint venture began in 2004. By 2010, you increased your stake from 50 to 75%. You've now bought all of it. But from my understanding is that Prudential Assurance had a put option so they could sell by 2015. So this is a year earlier than that agreement, as I understand it. So what was their thinking? Why were they happy to sell out a year earlier? And in fact, why are they selling out?
So it's interesting because we actually had a reciprocal put and call options. So starting from next year, for every year after that, we had the right to buy and they had the right to sell that remaining 25%. So we sat down with them in about May and started discussions to say, look, we don't want to come next year and all of a sudden we're going to call it or you're going to put it. What's your thoughts? And they came to a view that 25% didn't make sense for them. It was either to increase to 50%, which was one of the discussions we had, or to sell out altogether. And for us, it wasn't much of a choice. We said, well, in which case, we'll buy the remaining share. And then they said to us, we can wait for next year and follow the legal agreements. The legal agreements were put together 10 years ago and updated every couple of years. So it's very complicated. We decided rather we'll sit down together and work out a way that we can negotiate a smooth path for the transition. It's always better to do this as friends than to do it through the lawyers.
Yes, and cheaper.
and cheaper. So that's exactly what we did. We sat down and we said, okay, what do you want out of the exit? What do we want out of the exit? They said they'd like their brand back within a couple of years. We said, well, we'd like a smooth transition. We'd like some funding for a couple of years. We'd like the rights to transition the brand properly. Yes. We'd like, the message to be, go out with the same message together. Yes. And all of that stuff is quite important. Particularly, we'd like a good message with the regulator. We'd like you to help us. So they're very good with a regulated, very regulated environment, and we sat down with our lists, we made it up and put them down, and we came up with an agreement, and that's what happened.
Ricky, a number of sort of practical elements that flow from what you've just said. Amongst others, you refer to the branding. So I just want to bring in a clip that we did earlier with Adrian Gore, CEO of Discovery, on Discovery's plans to roll out the Vitality brand in the UK around this asset.
Vitality brand is valuable in the sense that it talks to the specific things that we do and how the product works. And in the UK, we've actually spent a lot of time and focus on building up the Vitality awareness. So you might see, the British football and a number of other properties that we're using, I think, quite carefully. So the research that we've done is that people generally are seeing a lot of Vitality, and I think by using the Vitality brand in the core companies, Discovery, of course, is at the holding level, will kind of make the company, the product, and the program synonymous. And the research we did show that that's the right strategy in that market.
So building out the branding, important strategy. Clearly, there will be some marketing costs in there.
Sure.
So as I said earlier, and I hope that's correct, this asset, this business is the 4th largest medical insurer, private medical insurer in the UK.
Correct.
How big is the sort of the next level to get up to the 3rd level? How hard do you need to work? And is that important?
The third, number 3 is actually not that much bigger than us, but there are 2 much bigger players than us. For us, it's actually not so much about size. It's actually more about 2 things. One is the underlying economics, in other words, more about profit, I guess, than pure numbers, but also more about, which is core to our model, is engaging people in changing their lives, because that ultimately leads to more profits. But it also leads to attracting people into the system that are seeing value other than just health insurance claims. And if we can do that, we can build this business. We also have, in addition to being the health insurer, we have a life insurer, which probably in the amount of new business being sold is probably number 3. And that's growing very quickly. And once again, engaging people through the same sort of Vitality model.
And Ricky, now without getting too technical, if you can explain to me, so now in you taking up 100% of this asset, my understanding is that the business now comes onto your balance sheet, whereas before it used to be on Prudential Assurance's balance sheet. What does that imply for Discovery, its capital requirements?
So previously what happened is that the life insurance business, exactly as you said, was written on the Prudential's balance sheet. We're going to apply for a new life insurance license, and we're going to start writing new business probably sometime next year, exactly as you said, on our own balance sheet. We're going to need to fund that. At the moment, the business, what's called the new business strain, the commission really, the cost of acquisition of the life business are being paid by Prudential. But we've done quite a lot of work around that. We've spoken to quite a number of banks, and it should be easy. Well, easy is an overstatement, but it should be doable. So we're fortunate we've got already in Discovery a huge business, and in the UK, after 10 years, a reasonable sized business. So we've got the scale and capacity to be able to do that. I think if we started from scratch, it would be much harder.
Right. So on that, so I think you've just made the point now. The model here that you followed with PruHealth was a partnership model. So low risk, testing the waters, doesn't put too much strain on the balance sheet. So this is what Discovery does, right? You see it in China, Singapore, Australia, and elsewhere. So would that continue to be what you do?
Yeah. We had an interesting experience, and it's well known in the market, in that we went to the US and we decided to start on our own. And we learned a lot of lessons. One of them is that when you go into a new market, as a South African company, you generally come without a brand. You come without a lot of money. And in insurance, which is particularly driven off a long-term view of the company and the sustainability of people trusting you with their money, that's quite important. So for us, it makes much more sense when we're expanding internationally that we expand in partnership with companies that often are very dominant in their space. So whether it be Prudential in the UK, whether it be AIA in Asia, or Adrian announced 2 weeks ago with Generali in Europe. And in each case, you automatically get brand, you get the balance sheet. What those traditional companies are traditionally lacking is the innovation and the flair that we bring to the party.
I get it. They're the dominant, you're the disruptive.
Correct.
Okay, right.
And you put the 2 together and it's a nice combination. And it also works quite well because in many markets people say, this is fantastic, it sounds great, but how do we trust it? And the way they trust it is because there's a brand behind it. Now in the UK we've built that brand. Over 10 years, we've built, Adrian's talking about the Vitality brand, and people understand it. But if you go into a new market, and we've had this exact experience in the US, and maybe the US was worse than other places, but people just didn't understand it. They didn't trust this company from Africa, and you inevitably end up having to do it with someone else.
Indeed. Now, Ricky, it leads to the next question. I'm sure it's the question you get at every results presentation, your African expansion strategy, because there aren't dominant players, there aren't developed players, so the partnership model presumably can't apply.
That's correct. I mean, our challenge in Africa, we aren't in Africa really, outside of South Africa, is the scale of the market. I mean, we're much better in going to markets that are already there and disrupting in some manner or means. And in the balance of Africa, there isn't really markets to do in that way. Other companies follow different models. So other insurers go with together a banking partner or something like that. Our model is to go into a market where there is a little bit of a market already and try and disrupt it and create different dynamics. And maybe in one or two countries there's inclination of that, but there isn't really anything in the balance of Africa.
But what does that mean then? So that means you're going to hold back and wait, or will you tweak your strategy?
At this point, it's a hold back and wait.
Yeah.
I mean, we're quite busy in the other countries. So it's pretty much going to be a hold back and wait. I think we have got a team that are looking at this on a constant basis. When we see signs or something that looks like it's got potential, we'll do something, but it's not on the top priority at the moment.
So to close by asking you, at your September results presentation, the statement was made, over the last 10 years, you've generated on average operating profit growth of 22%, pretty impressive. So how important is this partnership model? So we can't talk about an acquisition strategy because it's a gentle expansion strategy. How important will this be in helping to sustain that kind of performance?
No, fundamental. I mean, in South Africa we have two fantastic businesses in health and life insurance, but they're not going to grow at 22%. So we're going to get the growth by disrupting in other markets, whether it be the UK, whether it be in China, whether it be in Asia. This partnership model is fundamental to do that. It gives us that uplift to get some great growth in South Africa into the 20s.
Ricky, thank you. It's been lovely talking to you. We wish you all the best.
Thank you.
That's Ricky Farber. He's a financial director at Discovery. And from me, Erica van der Merwe, and the whole Deal Flow team, we trust you enjoyed the show. We'll be back in a week's time. Goodbye for now.